Well, the year is not over, and it's already time to start working on taxes. Chris Harper, an instructor at Grand Valley State University and senior manager with Hungerford Nichols, is here with a look at what to do to avoid those surprises.
You have a little time left.
Yes, and you need to maybe make a list so you don't forget, right?
You do, and it's really difficult to generalize because there are so many nuances to tax law, limitations, and things like that. So it's difficult in 4 or 5 minutes to say, this is exactly what you should do,
right?
But these are things that you should be thinking about.
Okay, and you say, look at the big picture.
Sure, I mean, you want to probably maximize your deductions or minimize your tax bill for 2019, but you also want to take a look to the future. Like, for example, if you expect to be in a higher income tax bracket next year, you might not want to push income into that year.
Okay.
Right? I mean,
right.
You might get a bigger tax deduction this year. It might have more effect if you're in a higher tax rate this year.
Okay.
So you have to kind of, you're thinking about, well, do I maybe accelerate some of my tax deductions? Like maybe I pay my January mortgage payment in December. Or
right.
maybe the tax bill.
That's a good one. January mortgage payment in December. Okay.
I mean, that's one way you could grab a little more mortgage interest and or maybe even pay your February real estate tax bill. You could pay that in December or something like that. But that's only if you want the extra deduction this year. What if you want it next year?
Right. And then you have to think about it that way. Okay. Those are some really, really good ones. And you also have to think about like life statuses and changes like that.
Well, there's been a huge one with divorces. For like 75 years or so, the rules with divorce has been that the payer gets to deduct the alimony payments and the recipient has to include them in income. That is a change for divorces finalized beginning this year.
Okay.
January of 2019.
So anything prior to that
is grandfathered in.
Is grandfathered in.
Yes.
So and it's just with alimony?
Just with alimony. Child support has always been tax-free to the recipient, and the payer never was able to get a deduction.
Yes.
So basically, starting in 2019, divorces that were finalized January 1 or after, the treatment is similar to child support now. So the person paying does not get a deduction, but the person receiving the alimony does not have to include it in his or her income.
That will be a big one for some people, right?
Yes.
Yeah, for sure. I have a question about house savings accounts. If you're, a lot of times I will have to like pay and then reimburse myself.
Yes.
And so how does that work with my house savings account and taxes?
Sure. So to the extent that you've taken a distribution from the health savings account, and that could be that you just reimbursed yourself or that you used a debit card to pay for something, as long as you use those for qualified medical expenses, then the distribution is tax-free.
Okay.
But if you used it for non-qualified things like personal expenses, then it's taxable and there's a penalty.
And so you need to keep the receipts for those then?
Yes.
All right.
Yep. Every time I reimburse myself from my own health savings account, I basically have the receipts and I just kind of staple them together and file it away, and then I could substantiate it.
Okay. That's good. I mean, I think that is something really important for people to get to know as they become more familiar with having these health savings accounts and how they can be used and how they cannot be used.
Absolutely.
Although a health savings account has a much broader base than the flex accounts. Yeah.
It does, and it carries over year to year. Flex accounts are use it or lose it. The health savings account, I know people, I can think of one eye doctor, for example, he doesn't take any distributions. He just puts the maximum in every year, and then he's kind of saving that up so that when he retires,
he's got a little nugget, right?
Yep, exactly.
Anything else we need to know about taxes?
Oh, I'm just looking down my list here, kind of the biggest things. You know, it's those last minute things like charitable contributions, for example. What about bunching itemized deductions? It's an odd concept, but you see, we had a lot of big changes started with 2018. The tax law, that was the biggest overhaul in 30 some years. So the standard deduction pretty much doubled for everybody. Like it's over 24,000 for married and over 12,000 for single. You may be able to craft a strategy where 1 year you take the standard deduction, and then you take a lot of your itemized deductions and bunch them into the next year, and then you get the benefit of those itemized deductions. And so it's like every other year you itemize, every other year you take standard. If you're close to the standard deduction threshold, that might be something that works for you. It's just something to think about.
Okay, yeah, that's a neat little trick.
Yeah.
You've always got something like that up your sleeve. I appreciate it.
We try.
I know. know. Well, if you want to remember, these are just general tips of advice. If you have questions about your specific situation, please contact a financial advisor. You can find all of these tips on our website, 13onyourside.com.